How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail something known as a retirement insurance policy. Now, there's not an actual term. If you go look up retirement insurance policy, I just want to let you know of how you could secure your retirement through utilizing insurance type contracts to make sure that you have that peace of mind that you could be receiving lifetime income, that it's not susceptible to downward market losses, not susceptible to fees, different things like that. Now, a lot of my videos, I constantly talk about insurance companies or insurance contracts, such as an annuity or such as life insurance. And there's many times that you could use those types of financial vehicles to accomplish your goals. Now, that does not necessarily mean, so I like using insurance companies for that aspect because they have certain tiers of safety in place to make sure that your monies are extremely safe when you're getting set up the right way. But that does not mean that I really like insurance companies. I honestly think that a lot of times insurance companies try to, create these contracts with very confusing financial language so that an individual gets suckered into those types of plans. So when you have a situation when somebody has, 1,000 different options available to them, and 990 of them are horrible contracts, but 10 of them are really good. We want to siphon through which ones are really bad, and then show exactly why those ones that are good are the best ones for that individual situation, and basically leverage it just like an individual tool in a tool belt. So, whether you have a mindset regarding insurance companies and insurance policies for retirement, always understand what are the pros and cons of every situation, and then can you find a better platform without using insurance companies for that peace of mind? And time again, I don't see that happening. So, to kind of get started in this conversation, what exactly are we talking about when we're discussing retirement insurance policies? And typically what happens is an individual is working throughout their working years and they're placing dollars aside into different retirement accounts, such as 401k accounts, such as 403b accounts, TSP accounts. Depending upon where you work, you're going to have these different sorts of employer-sponsored retirement plans that are established. On top of it, this individual might be placing dollars aside into savings. If they budget properly, they might be placing other monies aside into savings, or they sold a house, they sold a business, they received an inheritance, whatever that case may be. Now, those are deemed non-qualified type of accounts. So when it comes time for retirement and an individual is gearing up for their retirement, whether they're in their 50s, they're in their 60s, they're currently retired, they have these different types of buckets. I want you to think of it like buckets of maybe a 401k would be one type of bucket, maybe a Roth IRA is another bucket, maybe a traditional IRA is another bucket, maybe just, savings account is going to be another bucket. And then when it comes time for retirement, they say, okay, well, I've accumulated this. I've budgeted myself properly. I've placed this money aside. I've attributed this to, or I've connected it with some sort of mutual funds or market growth potential. But now what do I do? How do I pull these monies out without outliving those monies, without, running that risk of depleting all of these assets so that you have no monies? I've heard the horror stories. I don't want to be one of those individuals. And that's how you could set up your proper plan. It's not really that complicated. You just have to make sure that you're triggering your income sources most importantly. So if somebody is, let's say, currently age 60 and they're looking to retire at age 65, and they understand, okay, at age 65, I'm probably going to be receiving some sort of income through Social Security. Many times individuals are not offered a pension plan. They used to be a very easy way on how somebody was able to retire before, was a pension plan set up through their employer. Unfortunately, pension plans have gone by the wayside, so now they have to rely on these different sorts of qualified retirement plans to leverage for income. So let's just say if somebody was offered a pension plan and they're receiving pension income every month, well, then that's going to mimic a lot of how Social Security works, which is saying every single day or every single month that they're living, they're going to receive a paycheck from Social Security, a paycheck from pension. And then you have your retirement savings that are essentially sitting there. So when somebody's going and they're setting up, and this is just a really quick pointer, when you're trying to figure out what your number is, make sure that you're budgeting yourself properly. You're figuring out exactly what my expenses are at age 60, and then what I can assume my expenses to be at age 65 if that's going to be my ideal retirement date. Am I going to have as many expenses at age 65? Am I going to have ailments at that time? Is my health insurance going to be, more expensive? What are some of the different things? And try to overshoot that budget. Try to make sure that you're adding on worst case scenario. So let's say if this number, after you're doing your budget and you say, okay, at age 65, I'm projected that I need $60,000 of income to live off of each and every year. My Social Security is going to be there. It's going to give me 30 grand a year. My pension income is going to give me another $20,000 a year for a hypothetical example. So therefore, between these $50,000, but my need is 60,000, I have a gap of what? $10,000. So somebody could go and say, well, I've accumulated my assets in a variable mindset in speculation. I'm just going to stay put and, hope that the market's going to be good to me. Hope that the market's not going to have a reset, not going to have a correction, not going to fall into a bear market, and hope that I'm not going to outlive all these retirement dollars. So when I'm discussing the retirement insurance policy, there's different ways on how you can leverage insurance companies and their specific income contracts, such as an annuity, that will provide you, in this example, $10,000 of what that gap is. So what you could do is, let's say if you have a 401k account, you're sitting about $300,000. You might have Roth IRA account sitting at another $50,000, IRA account sitting at another $50,000, and you have $100,000 in savings. So in total, this individual has what? $500,000 worth of retirement assets or retirement savings. If we understand this process, well, why would you go? And this is the mistake that's made, is many times advisors or even insurance agents for that matter, what they're going to try to do is go after this full amount. And they're going to say, $500,000, let's go and place that into a income producing product. And that should not be the case. What you want to do is use the smallest amount of dollars of this 500,000 and only as much as necessary to accomplish your goal of the $10,000. So maybe it comes out to 200 grand that you could leverage. You lock into your contract, you get grandfathered into the best terms right now, so that even if things change in the future, in the next 5 years, you're still grandfathered into that contractual guarantee, and you're utilizing that cash flow percentage, that guaranteed cash flow number. So in this example, you would say, okay, well, all it's going to take me is exactly at age 65. I understand I'm going to have Social Security income. Let me clear off the screen real quick. At age 65, you understand that you're going to be having, Social Security income of that 30,000, the pension income possibly of that 20,000, and then you have obviously that gap of $10,000. So when you're going through all the best contracts out there, what exactly would be the best one in this situation? Let's say we had a female that was age 60 that was looking to retire at age 65. What is the best one for your particular state for a female age 60 looking for a 5-year deferral? So you're going to have a whole slew of carriers that come out, over 1,200 different options available. And that's what we try to do, is we try to simplify that process for you and say, okay, go with, if we have company A, company B, company C, and out of this $200,000 of a deposit, company A would only give you $9,000, company B gives you $10,000, and company C gives you $8,000, well, obviously you're going to want to go with company B because that requires the smallest deposit with the best possible contract. You don't have to throw any more dollars into it. So now what do we have? Because your income sources are covered, it took exactly $200,000 out of your $500,000 retirement savings to accomplish your goal. Now, the second aspect is emergency funds. You have $300,000 of emergency funds. Typically rule of thumb is, say you want to have about 6 to 12 months of what your expenses are to basically throw into emergency. So we could say about another $100,000 that we'd leave in liquid cash. And now you have $200,000 remaining that you could risk. You could risk those monies. You could keep that within those variable accounts that you were used to because of the fact that you set up your proper retirement insurance policy, for that income. So you could utilize this $200,000 to combat inflation, because obviously when you're triggering income at age 65 and it's $60,000, well, you need to also have step-ups in income, every few years. So you could ladder out your process. You could ladder out your retirement insurance policies to make sure that they're triggering income, triggering income, triggering income. When individuals hear the word annuities, also be mindful. You had innovations of annuities. It's just like the iPod. Kind of think of the iPod that came out in early 2000s. It was a big bulky thing that was able to hold X amount of songs. Now you could have the iPod Nano. You have these different features of an iPod. Same exact thing with financial products. All because you had products that came out in the 80s, the 90s, the early 2000s does not mean that those are the same contracts that are set up today. There's innovations set up with financial vehicles, innovations to make you more efficient. So that's essentially what you always want to hit home with, and saying, okay, if I could leverage, if I understand what my clear picture is, and I could leverage exactly, my current assets and only use the smallest amount of dollars and only as much as necessary to accomplish my income, accomplish my emergency, and accomplish my inflation goals, you could retire with confidence. You could golf every day. You could take long walks on a beach. You could do whatever you want, whatever you see, visit your grandchildren, whatever you see as your ideal retirement, you could do that when you set up these policies properly. What the mistake that's made is individuals go and they say, oh, I'm just going to leave my money in a variable account and make it susceptible to downward market losses. The reason why that is usually not a good idea when you don't at least have your safety net covered is because, once again, you don't have your safety net there. If you have variable accounts, you're most likely going to have to be paying mutual fund related fees. If you don't want to monitor those accounts yourself, you're going to have to pay an advisor fee to actively manage that portfolio. So those are two negatives that are automatically coming off. If the market experiences a downward market loss, that's the third negative. And then when you try pulling income from those accounts, that's the fourth negative. And then you're incorporating inflation, that's the fifth negative. So you have all these negatives that are basically compound interest going against your accounts. So many times advisors, wealth accumulation specialists, they always try to talk about the averages, or you have a 90% probability of not outliving your monies. Why would you go with a 90% probability when you could have a 100% probability by just not using your full retirement savings, only using a portion of it to make sure that you have that peace of mind? You have that golden parachute that says, okay, I have my income sources covered, so now I could work on my growth stage, and maybe now this is necessary to be paying these fees and take this risk, and I don't have to freak out if the market, occurs like in another 2008. So it's all about breaking it down to the most simplistic version, looking at the 30,000 foot view and saying, okay, what exactly is my situation? What are my goals? What do I want to accomplish? And how do I accomplish that properly? And that's exactly what we try to help you guys out with, is what you could expect when you give us a call. We have 24/7 customer service. So give us a call mornings, nights, weekends, holidays, whatever the case may be, 1-800-566-1002, and you'll speak with one of our admins. The admin's going to go ask you some questions, see exactly what you're calling in for, say, I want to retire, or I want to, set up a retirement plan, or whatever the case might be, and then they'll make sure to patch you over to a specialist specific to that area. That specialist is going to try to ask you questions regarding your situation and see, what you're currently doing will get you from point A to point B successfully. You could retire successfully. You don't have to change a thing, or there might be some gaps into your plan. These are some different solutions for your gaps. You might want to incorporate retirement insurance policies such as an annuity to close up those gaps, but it's not just a random company XYZ. It's saying which are the best processes, and this is why we use the Retire Sharp planning system to help us out, to use our case design team and make sure that we're going through every nook and cranny of your situation to make sure that we can give you the best recommendations, and then get set up. So it's all about education. It's all about seeing where you are, where you want to go, and then how to get there successfully in a very safe and efficient manner, so that you could have, you could spend your retirement with confidence. You could live your retirement years with confidence, have discretionary monies, have emergency funds, have inflation protection, have income streams, and just kind of do what you always wanted, to not work and enjoy your retirement lifestyle however you deem fit. So I hope you found value in this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Call our 800 number at any time. We're A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of our methodical process. I hope you guys found value, and look forward to speaking with you soon. Thanks so much.